Hello and welcome today. This is Paul Hoyt welcoming you to the Office Hours presentation on Monday, February the 10th. The Office Hours presentation is a relaxed, informal, free mentoring program that I do every Monday at noon Pacific time. This recording will be available online as well as many other previous week's recordings, and all of the recordings will be archived in our members area that we'll talk a little bit more about later on in the program. But this is Office Hours 22, so there's 21 previous recordings on a variety of subjects that are available to you, some for free and all of them in the course of our Office Hours library. The reasons I do this is because being a successful business owner can be a great experience, but it is tough. You need training on a lot of different subjects, and I want you to get to know me, because when you do get to know me, you'll know that I really care about you. I want you to succeed, and I have a lot of ways in which I can support you in doing that. Our agenda every week is that we have an in-depth discussion of a particular business success principle. Then we have closing remarks, special offers, and an invitation for next week's sessions, and then open questions and answers. Today's topic is the numbers don't lie, reading your financial statements. As always, I try to relate the subject matter of a presentation to the key performance areas that I defined in my book, The Foundation Factor, in 2004. And the one for today is square in the area of financial management. One of the functions of a financial manager is to take all of the results of the bookkeeping and translate those into financial statements and do the financial reporting. But today is also about leadership, because one of the responsibilities of the CEO or the business owner of a company is to run their business according to the business model that they have created. And the business model that they have created is often reflected in the budgets, and the way that you tell whether or not things are going the way that you want them to is through the reporting of the financial results in the form of financial statements. So it's not just about the financial manager, it's about the leadership function too. And just like sales, which is something that an owner of a company really can't abdicate, they need to have some competence in sales, you also need to have some competence in financial management. And that means learning how to read financial statements so you can have useful conversations with your CFO or your other financial management people. And I guarantee you your investors, if you're having investors for your company or other owners of the company, will want to have discussions with you about your financial results. So it's very important for you to understand the financial statements and how those report those financial results to your investors and other partners at your company. Today we're going to talk about the purpose of financial statements, and we're going to talk about the big three financial statements: income statement, balance sheet, and cash flow statement. Going to give purposes and examples and share a lot of details about each one of those. So let's get started with the purpose of financial statements. The financial statements are a standard way of communicating your financial status and your financial projections in the industry. So if everybody just kind of reported their financial results in the way that they felt most comfortable to, there would be no standardizations. So the Federal Accounting Standard Board has created these statements, and I don't know where they came from. The dual entry accounting system came from, I think it's the ancient Phoenicians, like 2000 BC, a long, long time ago. I don't know how long these standard financial statements have been around. Suffice it to say, when I started working with financial statements in 1970 or so, they were certainly around then. So it's a very standard way of communicating financial status and financial projections. People will ask you about your cash flow statement, your balance sheet, and your income statement, and expect you to understand how the financial results are laid out in them. So it's important for you to do that. But it's not just providing a standard way. It's also a way of managing your business. As we talked about earlier, we manage our business by looking at our financial statements. They facilitate the running the business by the numbers. Running the business by the numbers means that you have some budgets or you have some expectations, and the way you tell whether or not you're living your business within your numbers, within your budgets, and whether or not you're meeting your financial expectations is through the use of financial statements. So let's get started on the first one. The most popular one is called the income statement. It's also called a profit and loss statement. As far as I know, P&L and income statement are synonyms for each other. It shows you where your money is coming from, all of your revenue streams, and it shows you where your money is going to, which is all of your expense categories. It's also used to help you determine your break-even point, and it helps you run your business according to a budget. I'm going to show you an example of that in just a minute, but the most common place that we see our actual results versus our budgeted results, and the variance, the differences in between the budgets and the actual results, is in the income statement. Although I've seen people do budgets for balance sheet and budget for cash flow, it's most commonly done in the context of the income statement itself. So the income statement has several different sections to it. The revenues, the direct costs, which is also called the cost of goods sold, and it's sometimes also called variable expenses, by the way. It also has a section on operating expenses, which is also called the general and administrative expenses, and some people call that the fixed expenses. And it has the other expenses as well as a fourth one. Not all of the P&Ls have an other expense categories, but almost every one that I've ever seen has revenue and direct cost and operating expenses as three of the major categories within the income statement. So in the revenue section of the income statement, you might see all of your sources of revenue or sources of money outlined into product lines or individual products like product A, product B, product C, your services in service A and service B, and usually there's a line in there for less returns, or sometimes I see trade discounts as well. So in the revenue section of your income statement, this is where you go to see where your money is coming from, where your best sellers are, where you're making most of your money, if it be an individual product or an individual product line. Sometimes I see in the revenue sections it broken out by territory or by geographic area as well. Some people choose to break out their revenue streams by individual products or product lines, and some people choose to break them out by geographic territory. But usually it's revenue by product in the revenue section of an income statement. In the direct cost section of an income statement, we see a lot of different things. We might see commissions, both internal and external. That's the amount that you pay to somebody else based upon the revenue. And by definition, a commission is something in the direct cost section that is not paid unless you had the corresponding revenue. These costs are directly related to the revenue that is coming in, and generally you don't have a direct cost unless you have the revenue that's associated with it. And there are different types. There are the commissions, the royalties. Credit card fees are a classic example. You don't have that 2.5%, 3.5% credit card fee unless you actually got the money associated with that fee. And of course product costs, which are the cost of the inventory or the cost of the products, your cost, your landed cost of the product that you are delivering to your clients or customers, and any subcontractor fees or direct delivery costs that you might have. All of these different things show up in the direct cost section of your income statement. And in the third section, the operating expense section, well, we see lots and lots of things. This is a list I talked about in a little more detail when I gave the office hours presentation on creating financial models a couple of weeks ago. I'm not going to run through this entire list, but there are dozens and dozens of different cost categories or expense categories you may see in the operating expense section of your income statement. There's a bunch of them here, and of course you can get these slides on our website at office hours when we're done here, so you can read through the list on your own. One of the things that we see in the income statement is the concept of gross profit, which is a very important concept. So I'm going to spend just a minute talking about gross profit. Your gross profit is your revenues minus your direct costs. It shows you how much money you have left over, really money that you have left over for operating expenses and taxes and for any net profit based upon the revenues that you have. Because just because you sold $10,000 worth of merchandise does not mean that you have $10,000 that's coming into your company that's available for covering your operating expenses, for paying yourself, for delivering a profit to your investors, for paying taxes. Because some of that money that you have coming into revenues is almost always allocated to direct cost. So the gross profit is what you have left over. It is your gross revenues minus your direct costs. The target gross profit for most businesses is around 50%. Some businesses it's 25 or 30%. Some businesses it's 70 or 80%. But a good rule of thumb is 50% gross profit or 50% gross margin. And it helps you calculate your break-even point. I'm going to talk a little bit about break-even because that's also a very important concept that's related to the gross profit. The break-even point is when your gross profit is equal to your operating expenses, so that you have essentially zero net income or zero operating income is that point that we say that you have broken even. There's a couple of different formulas associated with break-even. One of them is units to break-even, which is, by definition, your operating expenses divided by the gross profit for every unit that you sell. There's also revenues to break-even, which is your operating expenses divided by your gross margin. Here's a couple of examples that may make that a little bit easier to understand. If you're making $5 gross profit for every unit that you sell, and your operating expenses are $5,000, then it takes 1,000 units sold every month to break even. Because for every unit you make $5 times 1,000 units is $5,000. That's your overhead for the month. So by definition or by formula, it takes you 1,000 units sold every month in order to break even to that point where your operating income is zero. Likewise, if you have a 50% gross margin and your operating expenses are $5,000, it takes $10,000 in total revenues to break even, because that $10,000 in revenues will generate $5,000 in direct costs, which leaves you $5,000 left over to cover your operating expenses. And if you've got $5,000 in operating expenses, then you have a $0 operating income and you have, by definition, broken even. In addition to showing you gross profit and your break-even status or break-even point, it also helps show you your operating income for the company, which is one of my favorite things. It's also called EBITDA. EBITDA is a very specific accounting term which stands for earnings before interest, taxes, depreciation, and amortization. I'm sorry I don't have that written down here. I forgot to include it in my presentation. But it stands for earnings before interest, taxes, depreciation, and amortization. That's a significant form of operating income for you because it's generally what we take and multiply by some reasonable valuation multiple to get the value of your business. So it's important for you to calculate that and understand it each month, because it will show you how your business value on the open market fluctuates based upon your operating income and your valuation multiple. Your income statements also show you your taxable income, and they show you what your net income, which is what you have left after taxes. So here's an example. This will hopefully bring this all together in a little example of an income statement. In this one, in this particular company, they have $10,000 of revenues each month, or this particular month rather. They have $5,000 in direct costs because their gross margin is 50% and their gross profit is $5,000. They have $3,000 in operating expenses, which gives them an operating income of $2,000, the operating income being the gross profit minus the operating expenses. In this particular company, they have other expenses, $500 every month, and this particular company is depreciation, which gives them $1,500 of taxable income every month. If they did a reserve for taxes, or this happens to be the month in which they actually pay their taxes, reserving 30% of their taxable income for taxes means they have a tax liability of $450. So their actual net income that the owners can enjoy in excess to their salary, and that may be available for distribution to investors, and that may be available for funding the growth of the business, is $1,050. So the $10,000 in revenue became $5,000 in gross profit, became $2,000 in operating income, became $1,500 in taxable income, became $1,050 in net income. And that's the way an income statement is read, and that's the information that it shows you. And when you print out income statements for your business, of course, there's going to be a lot more detail in the revenue section, in the direct cost section, in the operating expense section. So it will detail out where your revenue is coming from, each of your sources of revenue, where your direct costs are going to, each of your different direct cost categories, and where you're spending your money for operating expenses, all of the different operating expense categories. But I would also encourage you to think about having a little more in-depth picture than that. What I really like to see is an income statement that has budgets and variance associated with it. Again, with this company, the same company that had before, they had $10,000 in revenue, but they had budgeted $12,000 in revenue. They thought they were going to get $12,000 of sales that month, but they didn't. They only got 10. So they had a negative variance of $2,000. They thought that they were going to have $6,000 in direct costs, but they only had $5,000 because of the less sales. And because of that, instead of having a $6,000 gross profit, they had a $5,000 gross profit, or $1,000 less than what they thought that they were going to have. Now, this particular business owner was smart because they recognized that they were going to have a revenue shortfall and a gross profit shortfall. They cut back on their operating expenses. And instead of spending $3,500 for operating expenses, they only spent $3,000. So they were $500 under budget on operating expenses, which means that they were only $500 short on their operating income. Their other expenses were the same. The reserve for taxes went down because they didn't have as much taxable income. So at the end of the day, this $2,000 shortfall in revenues ended up being a $350 shortfall in in net income, which was money in the business owner's pocket. So by understanding what their budget was or what their expectations were and understanding what was going to happen with gross profit based upon the revenue shortfall, this particular business owner in this example made some good decisions and cut back on the operating expenses as well, so that they didn't have nearly as much shortfall in net income as they did in the gross revenues. I hope that makes sense to you, and if it doesn't, I invite you to listen to this section on the income statement a few times until it does make sense to you, because it's really kind of simple. The money we have coming in less the direct costs that we have, less our operating expenses, becomes our operating income. It only gets a little complicated, I think, when you bring into depreciation and amortization, which are classic other expenses, and the impact of taxable income. Hopefully that was helpful to you, but I want to move on now and talk about the two other types of financial statements we have. First, the balance sheet. The balance sheet purpose is to show you your assets, your liabilities, and the equity in your company. The assets are what the company owns, not what you personally own, but what the company owns. The liabilities are what the company owes, and typically who they owe that money to. And the equity then is what is left and who it belongs to. I think the purpose of a balance sheet is to help you focus on building the asset value of your company. Because for many businesses, the value of your company is not just the money that you're able to take out of it every month. It is the asset value of the company. Hopefully at some point in time, you might be able to sell your company to somebody else. And the way that you can tell what the asset value or what that market price of your company is not just the valuation multiple times EBITDA that we talked about a few minutes ago, but it's also the value of the assets that you have on hand less the liabilities that you have, which builds up the owner's equity. So in that asset category, there's a lot of different assets. We might have cash, accounts receivable, inventory, trucks and automobiles, buildings and land, and furniture and fixtures are some of the classic categories of assets, of what the company owns and what form that asset is. Some of these assets are a little more liquid than others, which means that they can be readily disposed of and turned into cash. Trucks and automobiles, you can sell those reasonably quickly, but not so with buildings and land, and usually not so with furnitures and fixtures. That's why trucks and automobiles, buildings and land, and furniture fixtures are called fixed assets versus current assets, which are typically cash, accounts receivable, and inventory. These are all listed on your balance sheet as assets that the company owns. In the liabilities section, we typically find just a couple of things: the accounts payable and the notes payable, which are the loans that you have from other people. Accounts payable is considered to be a current liability, and notes payable are typically considered to be a long-term liability, which means you pay them out over time. And this may be going a little bit too deep here, but current assets are those which can be disposed of typically within 6 months. Current liabilities are those which are intended to be relieved within 6 months, and everything else is considered to be a fixed asset or a long-term liability. And the final section of a balance sheet is the equity section, and that has capital accounts typically for every owner or investor that you have, and notes the impact of the distributions that you may have and the net income that you may have, which is also called retained earnings, and those are also listed separately. So here's what the balance sheet looks like. I've gone through a lot of words here, but here's what the picture of it. In this particular company, they have $10,000 in cash, $5,000 in accounts receivable, which is money that other people owe them and which they have a strong likelihood of receiving, and the inventory that they have on hand is $10,000, giving them $25,000 in total assets for the company. Notice, by the way, I said that the accounts receivable is that which is owed to them by their customers and clients and which they have a reasonable expectation of receiving. Once your accounts receivable goes beyond 90 days or a debt goes beyond 90 days or 120 days or so, you actually might not have a reasonable expectation of ever receiving that. So it's important for you to write it off so that you don't overinflate the assets that you have and not fairly represent your financial results to your investors, your business partners, or to the IRS as well. In the second section of this particular balance sheet, we show that this company has no notes payable, but they have $12,000 in accounts payable, which is what they need to be paying people, I would say, in the next 30, 60, 90 days. You can put some of your credit card debt in the accounts receivable category as well. In fact, most of it, goes in the accounts payable category. But in this company, they had $12,000 in accounts payable debt and $13,000 in owner's equity, so that their total liabilities and equity of $25,000 matched the total assets that they have of $25,000. And that's why it's called a balance sheet, because there has to be a balance in between the assets that you have and this total of the liabilities and equity. Those always have to balance. If you ever find that they're out of balance, which, by the way, almost never happens these days with the automated accounting systems that we all enjoy using. But boy, when we used to do stuff by hand, and when I used to create financial reporting systems and program those in the early days of the computers back in the 1970s, every once in a while we'd have a balance sheet that was not in balance, and you have to go hunt for a flaw in the system, either a flaw in the manual recording or a flaw in the programming one way. So that's what a balance sheet is all about. It's in balance in between the assets and essentially who owns those assets, you or somebody else. And that's what it shows you essentially the asset value of your company, which is in the owner's equity. In the cash flow statement, that purpose of a cash flow statement, which is the third type of statement, is to show you where your cash is coming from and where your cash is going to. And cash can be quite different than your booked revenues and booked expenses on your income statement. Sometimes cash is not received when it is earned, and sometimes cash is not sent out of your business when it is obligated, when you have the obligation. That's where accounts payable and accounts receivable come in. And sometimes cash is not spent in other categories too. So we'll talk about the impact of fixed assets here with our example. Cash flow statements come in two different formats that I've seen out there. The first format is where it lists the sources of funds first and then the uses of funds second. And the most common format, though, and the one that I prefer, shows the net impact on cash of your operating activities, the net impact on cash of your investing activities, and the net impact on cash of your financing activities. So here's an example that I think will clear this up just a little bit. I certainly hope so. In this particular company, from their operating activities, they had $1,500 of net income, but $500 of that net income the net income had been decreased by the impact of the depreciation of $500. So that was a way that was decreased their net income, which actually did not decrease their cash. So we're adding that back in as a source of funds. We had $1,500 of net income, but we also had another $500 contributing to our cash from depreciation. But we paid down some of our debt, so when we paid down our debt and reduced our accounts payables, that consumed $500 in cash. When we increased our inventory, that consumed $1,000 in cash. So in this particular month, we had net cash from operating activities as being $500. Let me run through that again. We made $1,500 on paper. We also enjoyed the cash impact of depreciation for $500, which was $2,000 of income coming into the company. We reduced our accounts payable by $500, which took away our cash. We relieved some debt, and we increased our inventory by $1,000. So the net impact of our monthly operations was to have $500 cash more at the end of the month than we had at the beginning of the month. But that's not all. In this example, this company decided to buy a car. So they increased their fixed assets by $25,000, which consumed $25,000 in cash. So the impact from the investing activity was to consume $25,000 in cash. But that they didn't really do that because they had financing activities. They borrowed $22,500 against that $25,000 car purchase, which meant that their net cash from financing activities was $22,500, which largely offset the decrease in cash from the investing activities, and the net cash impact from all of their activities was $2,000 less cash. So at the beginning of the month they had $10,000, and at the end of the month they had $8,000, because the net impact from all of those different activity categories was $2,000 less cash at the end of the month than they had at the beginning of the month. They gained $500 from the operating activities. They lost $25,000 from the investing activities. They gained $22,500 in cash from their investing activities, and the net impact of all of those different ways of cash coming into the company and going out of the company was that they had $2,000 less at the end of the month than they had at the beginning of the month. Here's another way of looking at that exact same scenario, and that is splitting the sources of funds separate from the uses of funds. In this variation of the cash flow statement, it shows that we had $1,500 in net income and $500 in depreciation, and $22,500 come into our company from a note that we had, from a loan that we had for the car. So we had a total of $24,500 come into the company in that month. We also had $500 go out to pay down accounts payable. We had $1,000 go out to increase our inventory, increase our assets on hand. Oop, let me go back. And we had $25,000 being used by the company to purchase a car. So our total uses of funds were $26,500, meaning that the sources of funds less the uses of funds was $2,000. And as we saw in the previous format for the cash flow statement, we had a beginning cash of $2,000 or $10,000 and ending cash of $8,000, meaning that we lost $2,000 in cash, or rather we invested $2,000 in cash in the business in that particular month. Now I understand that that's a bit of a mouthful, but one of the things that's real important for you when it comes to managing your finances is to really understand how cash comes into your company and how cash goes out of your company. When you buy fixed assets, understand the impact on cash. When you borrow money, understand the impact on cash. When you pay down or increase your accounts payables, or increase or decrease your inventory, or increase or decrease your accounts receivables, to understand the impact on your cash in each one of those different functions. In fact, the #1 business success principle that I talk about in my program, Beyond Business Survival, in the key performance area of financial management, is that cash is king, that you really have to manage the cash of your company. And learning how a cash flow statement can help you do that is a really important thing for you as a business owner. So, I know that's a bit of a mouthful. For some of you, you may benefit from going back through this program a couple of times, and looking at your own financial statements with this explanation and seeing how that all relates, and hopefully it will help you understand them and manage your business a little bit more. So here's your homework and your exercise. If you haven't done so already, I want you to implement QuickBooks or some other simple accounting system that provides financial statements easily to you, that you just push a button literally and get your P&L and get your balance sheet and get your cash flow statements and a lot of other reports that you can get out of there as well that will help you manage your business. If you haven't done that already, I strongly encourage you to do that. And the reason I say QuickBooks is because I think it has like an 85% market share for businesses with less than $5 or $10 million in revenue. So you're going to get a lot of support. A lot of bookkeepers will understand it. There's a lot of experts out there that can help you implement it. And if you're a small business, to me, by far, that's the best choice to make, is to implement QuickBooks. I encourage you to print out and study your financial statements each month. I really encourage you to create a budget and begin to manage your budget manage your business by your budget. And if it's not in the context of QuickBooks, then at least make it in your own head. You know, I expected to have $50,000 of revenue this month. I expect to have $25,000 in gross profit. I expect to have $15,000 in operating expenses. And understand what your expectations are so that when you get your financial statements, that you can fairly compare your actual results with your budgeted results and make some good decisions based upon that on what you do next month. So next month, you may choose to not pay the debt down as you had planned to, or you may choose to plan to do more of it down. You may plan to increase your line of credit or notes payable. You may plan to invest some more of your own hard-earned cash into the business. But without a budget and without a financial plan, it's tough to make those kinds of decisions. And the last part of your homework or your exercise is get help if you need it. There are some really great people out there who can help run through your financial statements with you each month. I sometimes operate as a part-time CFO for some of my clients, and I'm happy to go through the financial statements and work with them. Not all bookkeepers do that, by the way. Some bookkeepers are just bookkeepers. Other bookkeepers will also go through your financial statements with you and create a financial package each month and review that with you and play the role of CFO to help you learn how to read your financial statements and manage your company thereby. We're going to have open questions and answers in just a second. First, we're going to invite comments and questions on the topic of the day and then any other issues that you might have. But first, I want to talk to you about the programs I have and the ways in which we might be able to work together. I have a wide variety of coaching and consulting services. I've got a library where you can listen to the other 21 office hour programs and get a lot of other documents as well. And my Beyond Business Survival is my flagship CEO training program. The services that I have, like I say, a wide variety of them, strategic plans, business plans, financial models, empowerment coaching, performance coaching, and those programs start as small as just a couple of $100. Our library contains a wide variety of different documents that you're going to find valuable in your business. All the office hours recordings, dozens of other business document templates, spreadsheets, processes, sample legal agreements, and some bonus inspirational messages, and I'm adding to that every single week. You've got 3 pricing options for the library: a $279 one-time payment that gives you access to the library for your lifetime, or $79 a year, or for a very measly $9.38 a month, you can have access to all of the valuable information that I've accumulated over the last 12 years of being a business consultant. My Beyond Business Survival program is that critical small business owner training that you need. It's what you need to know when you're the CEO, because in my experience, people take 3 steps forward and 2 steps back, 4 steps forward and 6 steps back. And a lot of times those steps back that can slow you down or shut you down can be avoided with the proper education and proper training. You don't have to make a $10,000, $20,000, or $50,000 mistake if you know those business success principles and you've studied them. The Beyond Business Survival program is a self-paced, on-demand learning program. It's audio with complete transcripts and dozens of critical success principles. It's only $497, and I'm running a bonus right now that if you purchase the Beyond Business Survival training program right now, you'll also get free as a bonus a $279 value lifetime membership in my Paul Hoyt library with all of the stuff in that. I want you to join me on Facebook so you can get your energy of the day. That's a daily inspirational message that I've been putting out for the last 60 days or so. Next Monday, we haven't chosen a topic yet, so please go to paulsurvey.com and let me know what you would like for me to talk about next Monday, and we'll cook up a presentation that might be just perfect for your business so that you can get a free 20 or 30 minutes worth of valuable coaching and education for your business. So it's kind of a first come, first serve. Go to paulsurvey.com and let me know what you'd like for me to talk about next week. I have to pick that topic by Wednesday because I start on creating my presentations on Wednesdays and Thursdays, and I review them over the weekend so that I'm ready to do a quality job for you every Monday. Do your homework as well. So that when we meet next Monday, you've got some great stuff to report. Now let's go into questions and answers, comments and questions on the topic of the day or any other issues that you might have. I'm going to leave up my contact information, the link to paulsurvey.com, and my email address and telephone number. And of course, if you ever want to schedule a 15 or a 30-minute session with me for private one-on-one coaching or to talk about ways in which I can help you move your business forward and accelerate your growth, please go to schedulepaul.com and just sign up for an appointment. I'd love to have the opportunity to talk with you one-on-one. That's the presentation for today. So, Audra, did we have any questions today?
Paul, we did have some questions, and I actually have one really quick one before we start. You mentioned that you do financial models. Do you also help people understand their financial statements if they should need help?
That is true. I operate as a part-time CFO. For some of my clients, which has a lot of different responsibilities. One of the responsibilities of the CFO is to oversee the bookkeeping activities and to make sure the financial reports are in order and are correct, and to talk to the rest of the officers of the company, the owners of the company, about those financial results so that they can make good decisions based upon the financial results. So yes, that's exactly right, Audra. Do you have a question for me, dear?
I do. So Stuart says, balance sheets and cash flows are snapshots where P&L statements are a running record. Can you please elaborate on this?
Yes, that's well said. That's something I didn't talk about. But P&L covers a particular period of time. When you see, and actually, by the way, cash flow covers a particular period of time. So cash flow statement and the P&L statement are for a particular period of time, typically a month from the beginning of the month to the end of the month. But you can also get an annual P&L, which covers the beginning of the year up to the last month that you closed out your books and produced financial statements. So the profit and loss statement and the cash flow statement cover a particular span of time. They have a starting point and an ending point. The balance sheet is not that way. The balance sheet is a snapshot of where you are at any one point in time. So that doesn't make sense for a balance sheet to have a starting point and ending point. It is always as of a particular date. So we have the balance sheet as of the end of the year, as of the end of last month, as of 3 or 4 months ago, but it does not cover a period of time like the income statement and the cash flow statement do. Hopefully that helps. Next question, Audra.
I don't have QuickBooks. Do you really think I should get it? Or should I just use spreadsheets?
You know, I think very basic businesses can operate on spreadsheets. You know, and I'm going to date myself, which I seem to do a lot. But when I would learn accounting in 1973 or 4, actually I didn't take accounting in college, but when I got out of college, I quizzed out of a 10-hour course in accounting and found out that I really loved it. Back in those days, we did everything by hand. We had 13-column ledgers, and we created a balance sheet by hand. We created income statements by hand. We created cash flow statements by hand, which means a pencil and a piece of paper to create those things out. And we did things like trial balance, which were to see whether or not we were in balance, so that when we created our balance sheet, that it would actually balance. So we did it by hand, and then we updated and upgraded and started doing them with spreadsheets when VisiCalc came out in 1977-78 timeframe. And then we started having application packages. I don't know when QuickBooks came out, but Intuit created QuickBooks, I think, in the early 1990s or something like that. It was a long time ago, maybe a little bit even before then. But before then, we actually used pencil and paper, and we used spreadsheets when they became available, and you did most of that stuff by hand for small businesses. Because for a long time, by the way, small businesses did not have access to application software. Small businesses had to be run by spreadsheet or by pencil and paper. So you can do that, but QuickBooks is only about $300. My guess is you can get it a little more, a little less, depending on what versions that you buy, whether you buy the online version, whether you get a discount coupon, but around $300 is the cost of QuickBooks. And most of the time you can't work with a bookkeeper without having QuickBooks because it's so much more effective to them, and they don't want to do things by hand anymore. So if you ever want to hire somebody to work at your company, or get use the talents and skills of a bookkeeper or a CFO, you can't do it by hand. So the only reason to do it by hand is if it's really, really simple, and if it's only you're the only one going to be doing it. So but I encourage you not to do that, because my hope for each one of you is that you build a business that has some asset value to it, and you have a business that's got, you know, 50, 7,500, 200,000, 500,000, millions of dollars in revenue, and you can't manage businesses that are much bigger than, you know, just a few dozen thousands of dollars without using a quality application software package like QuickBooks. So just as my friend Audra oftentimes says, just suck it up, cupcake, and go buy QuickBooks and learn to use it yourself, or hire somebody to help you implement it and hire somebody to help you use it for your business. Next question, Audra.
So that's a perfect lead-in, Paul. How much do bookkeepers cost?
Bookkeepers, I have been, by the way, researching bookkeeper costs for a few clients of mine that are just getting ready to go down the road. They're just getting started. You know, their funding is anticipated in the next few weeks or so. So, you know, putting on my CFO hat, we're helping them get established with bank accounts and EIN numbers and, you know, formal organization of the company and all that sort of stuff. And one of the things we're helping them do is look at bookkeepers. So I've seen costs in the last few months anywhere from $55 to $65 an hour. And as always, I'm a big fan of the 3 expert rule. Go get yourself 3 quotes, check the references on the ones that you think are going to serve you the best, and find a bookkeeper that really connects with you, that you know that you can trust with the financial results of your business. Most people, you know, you hold that private. You don't share it with your employees. You don't share it with very many people at all. The financial results are yours as the owners of the business and whoever is responsible for helping you create those. It's confidential information. So it needs to be somebody that you trust, not only trust that they can do things correctly and on time, but you trust with opening the kimono, really showing them what's going on in your business. So the current range that I've seen of people that I think are really qualified and I've had the opportunity to do business with is in the $55 to $65 an hour range right now. Next question, Audra.
Do you have any recommendations for bookkeepers?
I would say send me just send me an email to paul@paulhoyt.com or just go to schedulepaul.com and schedule a 15-minute conversation. That's probably even a little bit better because I'd rather give you that one-on-one and than in the context of this recording right now today. So please just connect to me. Go to schedulepaul.com, schedule a 15 or a 30-minute presentation if you like. Next, Audra.
So how long should it take for a bookkeeper to do my books each month? How do I know if I'm being ripped off?
It really depends on the number of transactions that you have and what you have the bookkeeper do. So bookkeepers come in a lot of different flavors. Some of them, generally speaking for small businesses, by the way, as a rule of thumb, we're in the 6 to 10 hours a month range. So from a cost standpoint, you're in the $300 to $600 cost, but I've seen other ones be $1,000 a month. I've got one client that does governmental accounting, DCAA compatible accounting, which means that's a lot more complex. They have to have project accounting done, they have to have accrual accounting in place, and their fees are much larger than that because it's a much more complex environment. If you're running payroll, that can add to the charges, and it can be based upon the number of people that you have in payroll. If your bookkeeping firm is also doing the financial statements and allocating an hour a month to have a conversation with you about your financial results and maybe give some advice as to what you might do differently in coming months in order to meet your budgets and meet your expectation, that can be an additional charge. If you want your bookkeeper to help you come up with the budgets in the first place, that can be an additional charge. So it really varies as to what you want to do. But I would say, generally at a minimum, you're in the $300 to $600 price range for working with a bookkeeper to do your stuff on QuickBooks and share that information with you on a monthly basis. And as your complexity increases with payroll, with governmental accounting, with accrual accounting, with project accounting, and all of the different ways that your accounting systems can increase in complexity, then you might expect your fees to go up as well. Hopefully that helps. Next question, Audra.
So this one leads right into the previous. What's the difference between a bookkeeper, an accountant, a CPA? What do I need? Which level?
That's an excellent question. I talk about the 5 different roles that there are in financial management. The bookkeeper being the simplest and the least expensive role. The bookkeeper is the one that typically books all of the expenses. When somebody sends you an invoice, they put it into the system. They may write the checks. They may create the invoices and deposit the checks that come into you, or record the deposits that come in via credit card or via wire transfer in some way. So they typically post the transactions. That's the key function of the bookkeeper, is to post the transactions. At the next level up, you can have the accounting or the controller function. And the controller function and the accounting function is generating financial reports and implementing and managing financial controls. So the controller, that's why it's called the controller, is because the controller implements and manages your financial controls. So hopefully you've got some checks and balances in your system. The same person, for example, that records an obligation, an accounts payable, doesn't also write the checks. The same person that takes the checks doesn't deposit the checks. Big companies have financial controls in place so that they've always got 2 pairs of eyes looking at every transaction that goes through the system to limit the opportunity for mistakes and to limit the opportunity for embezzlement and fraud. That's the accountant's function or the controller function, and they also, by the way, report the financial results. The CFO has the function of first of all, managing all of the different accounting or financial management functions, and then having conversations with the other executives at the company, the chief executive officer, the chief operational officer, the vice president of marketing and sales, and letting them know how the financial results that you've had may impact future decisions that they make. So they're really responsible for helping the other executives at the company manage the company based on the financial results that have been created by the bookkeeper and shared by the accountant. The other two roles in financial management are the CPA, or the outside tax advisor, someone that's responsible for compliance that will help you make sure that your taxes are being paid appropriately, that you're paying your payroll taxes and your sales taxes and your use taxes, and reserving and remitting federal income taxes and all the different tax categories that are out there. And the fifth function, by the way, is the treasury function, which helps you manage the cash flow. So I call those the 5 functions of financial management: the bookkeeper, the controller, the CFO, the compliance, or the outside person who manages compliance. Typically can be a CPA, but it doesn't have to be a CPA. It can be an outside accounting firm. And the treasury function, which is managing your cash flow. So those are the different functions. Some bookkeepers also act as controllers and accountants. They also act as CFOs in helping you make good decisions how to run your company based on your financial results. Sometimes you will have a CPA firm, somebody that does your taxes, that also will do bookkeeping. So they may operate in that role as well. It's typically somebody inside your company that always manages the cash. So that's why it's real important for you or somebody else to really understand the cash flow statement and how that will help them do so. I hope that helps a little bit. But the bottom line is that there are people out there who do some accounting stuff and not the other ones. Some bookkeeping firms, like I say, provide all of those functions, and some bookkeeping firms are just bookkeepers and don't do any of the rest of that stuff. You can find a lot of different service providers providing pieces of the puzzle, and it's your responsibility as the CEO of your company, as the business owner, to make sure that you have all of those pieces of the puzzle put into place. That was a little bit long-winded, but next question, Audra.
So I have a service-based business. What are my assets, or do I even have any assets?
You know, service-based business, typically you might have a company car. It's not uncommon for somebody to put their company car or to purchase an automobile that they use, especially if their service involves going around town in some way. So if you're a painter or a roofing contractor or somebody like that, you might have trucks and automobiles as part of the assets of your company. You might have tools and machinery as part of the assets of your company. Everybody can have a computer as part of the assets of their company that will show up on the balance sheet and have some book value on the balance sheet, and that would be the assets of your company. You generally don't have the value of your intellectual property listed on the balance sheet, or the value of your goodwill, the value of the relationships and the connections that you've established over time listed on the balance sheet until you sell the business. And when you sell the business, whoever bought the business from you, say for example that you have $5,000 of assets on the books at your business, but somebody paid you $25,000 for your business, that extra $20,000 is typically listed on their balance sheet as goodwill that is amortized over time, which is the value of the relationships and the connections and the goodwill that you have built up in the industry and which they have received as a benefit of purchasing your company. So service-based businesses, if you're a coach, you may not have any assets on the books at all except your cash and accounts receivable. If you've got products that you sell, like books or information products, you may have some inventory represented at your company, and you may have the value of your computing systems. And with other service-based companies where there's tools and machinery and trucks and automobiles, they may have those on board. If you're renting an office space and you have your own cubicles and desks in there, you may also have some furniture and fixtures as assets of your company. I think that about covers it. Audra, next question.
So if I have to have certain kind of training, either to be certified or I need special training because let's say I'm a programmer and I have to take courses, how do I incorporate that into my balance sheet? Or what is that? Are those costs or those assets or what?
Those are almost always expenses. I don't know of any, I haven't seen any examples of where you would be able to capitalize, and the word capitalize means that we are recording an expense as an asset and we're not taking all of the expense today. So when I capitalize a computer system, that means that I'm declaring it to be an asset of the company, and I'm not taking all of the expense involved with the purchase of that asset right now today. But I've never heard of a situation where you could capitalize an individual training program. The exception I would see to that would be if you bought say a lifetime license at a training company that allowed you access to multiple training programs over multiple years. Then you might actually have to, from an IRS standpoint and from a tax standpoint, capitalize the value of that asset and depreciate it or amortize it over time. But generally speaking, when you and I go out and take a training class for $500 or $1,000, or we go to a business growth conference of some kind for $10,000, that's a current expense and is deducted from your taxable income in the year in which you actually had the expense. Hope that helps. Next question, Audra.
It does. It actually created another question. So I don't really understand, you're talking about capitalization, depreciation, amortization, and all these other Asians. Can you please help me understand those?
And we're getting at 12:59, by the way. I'm going to take a couple of more questions, but I understand if some of you need to depart because we're coming up to the top of the hour. So the general principle of taxation is that you want to match your income and expenses together in a period of time that makes sense. So some of the things that you purchase, you're not actually going to expense all of the value of that asset in a particular taxable year. A classic example of that might be an automobile. If you go out and spend $25,000 for an automobile, that automobile has a useful life, and that useful life can be said to be 5 years. For some people it's 10 years, but a 5-year depreciation on an automobile is a common thing. So that we'll say that that has a useful life of 5 years, and that means that you take 20% or 1/5 of the expense of that car this year, and 1/5 the next year, and 1/5 the following year, and so on, until you have fully expensed that asset out on your balance sheet. So what, generally speaking, the IRS says that just because you bought a car for $25,000 does not mean that you can deduct all of that expense in this taxable year because you still have the asset. We're not going to let you reduce your taxable income by $25,000 this year because you still have the value of that asset for a number of years. So they might say you can deduct 20% of it this year, 20% the next year, and 20% the next year. So generally speaking, we try to match up the expense with the useful life of a particular asset, so that that expense is recorded as a tax deductible expense over time. We match the usefulness or the wearing out of or the actual expense of that item over a period of time based upon the useful life of that item. I'm not sure that that was as clear as I would like for it to be, but that's a very good concept to know, that some things that we buy for the use in our company, furnitures and pictures, trucks and automobiles, long-term licenses, other sorts of things, cannot be expensed this year. In other words, they can't reduce your tax liability this year. They have to be put on the books as an asset of the company and have it reduce your tax liability in the years to come based upon the useful life of that particular asset. Hopefully that was helpful. Audra, next question.
So Darlene is asking, as everyone converts to downloadable information, how do you qualify this as an asset, i.e. people who have transferred their DVDs and books to electronic form? It isn't being stored in a warehouse as inventory, so how do you deal with that?
You actually can't. You could at some point in time declare an asset value or an intellectual property value to that. Well, by the way, it would have no impact on your cash or on your tax liabilities at all. But I could, for example, simply declare that on my balance sheet I have $100,000 in intellectual property. I just declare that to be the value of my information products that I have created, and therefore it increases my assets by $100,000. And because I don't owe that to somebody else, it also increases the equity, the owner's equity in the company, by $100,000. So my assets are increased by $100,000, and my equity is increased by $100,000, and my balance sheet is in balance. That might be useful, by the way, if I was declaring that value to a potential investor. If you said to an investor that, you know, my business is worth $100,000, and you're going to buy, you know, 20% of my business for your $20,000 investment, they might take a look at your balance sheet and say, but you only got $5,000 in cash here. How can you tell me that your business is worth $100,000? And the difference is in that goodwill category, or the value of your intellectual property. So you can arbitrarily do that, which may be of value to you when it comes to declaring the value of your company to investors, but it has no impact whatsoever on your taxable income or on your tax liabilities. And usually people don't declare the value of their intellectual property until they're raising capital or until they're selling their business in some way. Hopefully that was helpful. But generally speaking, by the way, if it's not in physical form, then it doesn't have an asset value as far as the IRS is concerned. And by the way, it may not have an asset value as far as banks are concerned either. One of the purposes of having a balance sheet, which I didn't cover in the presentation, is that banks will oftentimes want to see your P&L and a current balance sheet, because they want to see what assets that you have on hand, which may have some collateral value, which may make loaning you some money a little less risky for them, because if you default on it, you may have some actual assets that can be sold on the open market and used to pay off the debt that you have with the bank. Next question, Audra, and we're running about 1:05, so let's make this the last question.
Okay. It sort of relates to an asset. Earlier you sort of spoke about relationships or goodwill being possible assets. So would a relationship, for example, with somebody like you be an asset?
Well, I'd like to think so. I mean, in terms of the more generic use of the term about having some value to you. And, you know, our relationships, business is all about relationships, good relationships with customers, good relationships with suppliers, good relationships with our investors, good relationships with our employees, with our subcontractors, and with our advisors too. So I would definitely consider those connections to be a valuable asset of the company. Now, whether or not you can put it on the books and declare it, you know, as an asset that a bank might be interested in, or an asset that an investor might be interested in, is another question entirely. I think that an investor would be far more interested in it than would be a bank, somebody at a bank. But generally speaking, we don't declare the goodwill value of things like relationships. We just have conversations with people who might want to buy our company or invest in our company about why we are valuing the company at something that's greater than the book value of the company. And usually that answer is because of the goodwill that we've established with the relationships over time, the connections that we have, the brand awareness that we have, those sorts of things all have a tendency to increase the value of our company, but are not shown on the balance sheet typically as assets of the company, like I say, until we decide to actually sell the company. Hopefully that was helpful for you today. I really enjoyed this because I enjoy everything that has to do with financial statements. If you have other questions, you are welcome to send those to me, to paul@paulhoyt.com. You're also welcome to go to schedulepaul.com and pick a 15 or a 30-minute window, and we can have a private conversation. Or give me a call at the number that's listed on your screen, 415-997-8001. And if you have any other topics that you'd like to see me to address on future office hours presentations, please go to paulssurvey.com and just share that with me so that I can cook up a presentation that's just right for you. Until we meet again, this is Paul Hoyt saying goodbye, and I'm wishing you a most marvelous and prosperous day. Goodbye.